Good afternoon, everyone. I think we're going to get started here with our annual nonprofit tax update for the year. So, quick introduction about your presenters this afternoon. You got myself, Dan Sweeney. I'm a tax director over in our Omaha office. I specialize in some of our specialty areas, including nonprofits. And with me today is
I'm Samantha Speck. I work in the Grand Island office and I will be specializing in the nonprofit area, but right now I'm just tax in general.
quick little slide about us and then our agenda for this afternoon. So, I mixed it up a little bit from what was sent out earlier. With the one big beautiful bill, I figured most people would be curious to hear about the tax updates first. So we're going to push that to the forefront. So we're going to go over our tax updates for nonprofits with the one big beautiful bill, some of the things that are in there that would be good to know. Then we're going to switch over to the Form 990 and just some overview and best practices. This might be a little basic for some people, but it is just a good refresher of the different things that are out there. Then we'll get into the common errors on the Form 990. We just got done with our 11/17 extended deadline for nonprofits. We went through a variety of different returns, some of the things that we saw on there that we thought would be good for people to know as we finished up our deadline. Next on the agenda is uses of private foundations. When we gave this presentation last year, one of our survey questions was, what topics would people like to hear about? By far and away, our largest topic that people wanted to hear more about was just a little bit more on uses of private foundations. What's a private foundation? Doesn't it make sense to use this type of entity compared to a public charity? And lastly, my favorite section, Sam and I are going to go over some of that industry annual trends. These aren't necessarily tax specific, but different things that we're seeing in the nonprofit industry as a whole, different rulings that came out, cases that have come out, some statistics that have come out about what's going on. Now, a couple of housekeeping issues before we move forward. If you have any questions, please feel free to send them in the chat, but we will hold any questions to the end where we will read through them. And for anyone that's looking for a copy of the slides, we will send those out as well. So those will be coming. So kicking us off right away with our tax updates. The one big beautiful bill. I wanted to give a quick overview of what happened here, because if you were following along in the news earlier on this year, we really had three different versions of this bill out there. We had a House version, we had a Senate Finance Committee version, then we had the final Senate version. So we were really looking at three different versions of this bill. The reason I want to mention that is, if as I go through these tax updates, you hear something that sounds a little bit different, or, oh, I didn't think that was the case, you might be thinking of a earlier version of the bill and not the one that eventually got passed. So what's on these slides are the final official versions of what was in the bill as it relates to nonprofits. I will say when it first got released, I was pretty excited. The House version had a lot of different changes with respect to nonprofits. Usually I give this presentation each year and there's not a whole lot of tax updates to talk about. I was getting pretty excited that we might actually have something this year. But as we worked our way through the Senate Finance Committee and then the Senate version of the bill, I ended up saying, that's it. We really didn't get that many nonprofit tax updates as I was expecting from the first version of the bill to the final version of the bill. Nonprofits didn't get all these changes that they were talking about in the House when we got to the final version of the bill that got passed in July. But there were a few things in there, maybe not directly related to nonprofits, but at least related to your donors that you do want to keep in mind. As a general overview overall, before I get into the nonprofit specific positions, what the One Big Beautiful Bill did is back in 2017, we had the Tax Cuts and Jobs Act, and it introduced higher thresholds for the different tax brackets, lower tax brackets, new deductions, things of that nature. The One Big Beautiful Bill made a lot of those temporary deductions from the Tax Cuts and Jobs Act basically permanent going forward. So there's going to be more generous business deductions in the future, and there will be an impact on charitable deductions with this One Big Beautiful Bill that wasn't really related to the Tax Cuts and Jobs Act. So for the Tax Cuts and Jobs Act, a lot of the provisions were set to expire at the start of next year, start of 2026. One Big Beautiful Bill stopped that, just made a lot of these prior provisions permanent. So there's not really a whole lot of changes really with the One Big Beautiful Bill for individuals and businesses, except when we get to the topic of itemized deductions and charitable deductions in particular. So what are we talking about for charitable deductions from my donors? Some pretty big changes in the One Big Beautiful Bill, which they had to do for some scoring metrics in order to cost the bill so it could pass. So what are we looking at? Brand new limitation for corporations. Corporations are now subject to a 1% of their taxable income limitation. And that basically acts as a floor or a threshold amount. I need to get over that 1% of my taxable income before I even get a tax deduction for my charitable contributions. So it's a little bit more of a speed bump ahead if I'm a corporation or I take any type of deduction for my charitable deductions. I'm going to be making more charitable deductions in excess of my taxable income before I can even get a benefit. On the plus side, something that the industry has been asking for a long time finally happened, really makes me happy. Now there is a new above the line deduction for $1,000 if you're single or $2,000 if you're married. What this means is that individuals no longer have to itemize their deductions in order to get some type of charitable deduction. So I can just get a $1,000 deduction or $2,000 if I'm married by giving money to charity without having to itemize. We had something similar to this when we had the COVID changes and the COVID tax updates, where we had a small above the line deduction. This one's a lot bigger. And now you do have this option for more donors where they can actually get a tax benefit from giving money to charity as opposed to only those that can itemize their deductions. And with the changes to the itemized deduction threshold, that threshold is really about $30,000 now. So it's really tough for more normal people to try and get that $30,000 of itemized deductions where they can get a charitable benefit for their deductions. Now, more normal people can get this deduction. More typical taxpayers can take advantage of it. While we got something good, we also got something bad. So for higher income taxpayers, there's also a new 0.5% adjusted gross income limitation. So for higher income taxpayers, similar to the corporations, there's going to be this floor or threshold amount. So there's this 0.5% of my adjusted gross income that just gets wiped away. I don't get any type of deduction for that. I need to get above that threshold before I can take a deduction. 0.5% is not a huge change to charitable deductions, but it is still something where I'm going to take a little bit of a hit for my high dollar donors who are trying to give money to charities. 60% of AGI limitation has been made permanent. There's this weird thing in the bill, if you look at it, where it's talking about itemized deductions being reduced by 2/37. When you get into all the math and all the calculations there, what it really basically does is if I'm a taxpayer in the top 37% tax bracket, my itemized deductions are really only going to be giving me a benefit as if I was in the 35% tax bracket. So it basically shaves off 2% of a tax benefit for me if I'm in the top tax bracket. I'm only going to get a benefit as if I was in the 35% tax bracket. So this 2/37 reduction and this 0.5% limitation of adjusted gross income will be pretty big deals for high dollar donors. Otherwise, most normal donors get a benefit with this new $1,000 or $2,000 deduction that's out there where they don't even need to itemize. So what can you do with some of these changes? What we have been encouraging people to do is, if I'm working with the donor or even some of our individual clients, 2025 is a year for us to gift. We want to do big gifts at the end of 2025 so we can avoid these new 2026 limitations on my gifting. Because if I go to the next year, 1/1/26, these new limitations come into effect. So we really want to keep the old limits where we're not limited in 25, do lots of giving at the end of 2025. The caveat, though, is I can't do too much giving, because if I have any 2025 carryovers where I'm above that 60% AGI limitation, those will be subject to the new limitations in 26, so that 0.5% or the 2/37. So I need to kind of be in the sweet spot where I do a bunch of donation this year, but I don't do too much where I end up with a carryover for next year. All that being said, there's another idea that's out there that you might want to think about as well. So if I'm a business, I have the option to say whether my donation was a charitable contribution or whether it was really more like advertising or promotional. And the IRS has blessed this approach. So there has been some rulings in the past. Or if I'm a business, I could be saying, well, this isn't a charitable deduction for me. This is an advertising expense because I'm getting my name out there in the community. I have a sponsorship. I might be a bronze, silver, gold medal sponsor. They put my name on the banner across things. So really, I did this for promotional reasons than just out of the kindness of my heart. And if that's the position you're taking, now as opposed to being a charitable deduction where I get subject to these limitations, it is now a business expense where I'm not. So that might be an angle to consider if you're doing sponsorships for some of your donations or putting business names out there. That's an alternative than being hit by some of these charitable deduction limitations, trying to go the business expense approach. Now, obviously, with that, you can't get too far. You can't make it where it's like pure advertising, because then it puts your nonprofit itself at risk for maybe having unrelated business income, because now you're doing advertising as opposed to just, well, we're just putting their name on some of our promotional materials. So there is a fine line to walk there. But if you're concerned about some of these limitations for individuals, maybe talk about them doing the donation through their business where they can take a business expense where they're not going to be subject to some of these big limitations. A couple of other items that are out there. So just something to keep in mind, there's going to be a brand new tax credit starting in 2027, $1,700 for individuals who give contributions to a qualified scholarship granting organization. And what's a qualified scholarship granting organization? We don't know yet. IRS will be releasing a list that says all these organizations qualify. If you give money here, you can get a tax credit. So the hope would be to promote scholarships to different schools out there. Brand new tax credit doesn't start till 27. Downside for the donors is some states have a similar program where you can give money to a state program for scholarships and you get state tax credit. You can't double dip. You can't get both the federal credit and your state credit. So it's one or the other. I'm sure we'll hear more about that in the years to come, but keep in mind that this is a different option for donors that are out there. Okay, really the only thing that came about for nonprofits in the One Big Beautiful Bill when it comes to tax changes is this college endowment tax. All the other provisions basically fell by the wayside. The one that actually stuck around is now if I'm the Harvards, the Yales, the Browns of the world with high endowments, I have to pay a graduated tax at my investment income. In the past, it was just 1.4%, but now it goes in tiered structures of 1.44, 8% on my investment income if I'm one of these colleges that are subject. But really, with some of the exceptions that are in there, it's a pretty tiny pool of schools that are actually going to be hit by this. So I can't really imagine it being more than 30 to 40 schools that really have to worry about this endowment tax based on the exceptions and the qualifications. But if you are a larger school, this would be something for you to worry about. The other nonprofit provision that came out there was related to highly compensated employees. If you try to parse through the language, it's very confusing. So I'm just going to cut to the chase to what they're really talking about. So if I'm a nonprofit and I have an employee getting paid over $1 million in salary, I typically am going to be subject to an excise tax that needs to be paid on that salary. What this provision does is expand the definitions, because currently, or prior, how it worked was it was just the top 5 employees getting over $1 million would be subject to this excise tax. Now it expands it to all current employees, and employees going all the way back to 2016, they're still getting paid out from the organization. So this starts next year. If you have compensation over $1 million, really this doesn't change a whole lot unless you had a lot of employees getting paid over $1 million, or you've had some prior employees that are getting some type of payout from the past. Now you might be a little bit concerned that you might be subject to this excise tax as well. But it's not as far reaching as people were thinking when the first version came out in the House bill. Some just miscellaneous things that are going to be good to know. 1099s, we used to have a $600 threshold for 1099s, still in place for 2025, but next year, 2026, jumps up to $2,000. So thankfully, any of my small payments that I'm making out to vendors or things of that nature don't need to worry about doing a 1099 anymore. And those thresholds will be adjusted for inflation going forward. So hopefully it eases some administrative burden. We don't have to do it on the super small payments going forward, just kind of small payments. So $2,000 and above starting next year. A couple of other items that do not directly impact the nonprofit, but it can impact you if you have employees working for you. So 2 big lauded provisions that was all over the media were this no tax on tips and no tax on overtime. It's definitely a misnomer though, because that's not getting rid of all taxes completely on tips and overtime. It's really just an income tax deduction for those employees. So it doesn't even hit their payroll taxes, it might not even hit their state income taxes. It's really just a federal income tax deduction that that employee gets to claim on their personal tax return if they get tip income or if they get overtime pay. When you look at this no tax on tips, IRS very recently released a schedule listing out their tentative 68 occupations that are going to qualify for who can take this tip deduction. So it's not just anyone who gets paid tip income. When you read some of the legislation here, it's talking about, well, you've had to get tips in this industry in the past as well. So me as an accountant, I can't just start taking tip income and claiming this deduction. Accountants aren't an industry that typically get tips. But if I was doing anything in the hospitality industry, or I historically have gotten tips in what I've been doing, this is the type of deduction that applies to you. Originally, they said that you had to start doing some reporting to your employees starting this year in 2025, because this deduction goes from 2025 to 2028. Very recently, beginning of this month, IRS released guidance saying, we know this is going to be tough to have employers try and comply with it this year. We're giving you a grace period for this year, but starting next year, when you have your W-2s or 1099s, you need to break out the portion that's going to be tip income or overtime income. But this year, they're just saying, well, if you could please just give your employees some type of reporting that's not official that says, well, we think this portion of your wages was tip income or this portion was overtime, that would be appreciated for us. And just going over to the no tax on overtime as well. Similar type of thing. It's not getting any taxes on overtime. It's really just a deduction for that employee that they claim on their personal return. Difference is, as opposed to $25,000, I only get $12,500 if I'm single. I can get that $25,000 if I'm married. Likewise, we were supposed to have procedures in place to report it to our employees this year if I got overtime pay. IRS backed off on that for 2025, but starting in 2026, there will be disclosures you need to do to your employees who are getting overtime so they can claim this deduction on their personal return. And I heard comments before, some people asked me questions like, what is qualified overtime compensation? So I have it up there on the slide. It's overtime pay required to be paid under Section 7 of the FSLA. That is in excess of the regular rate. And from my understanding, that basically means time and a half. So any time and a half time is what can qualify for this deduction. Excluded provisions, I wanted to mention this as I started from the beginning. We have like 3 different versions of this bill. So some things that were discussed that did not end up in the final bill at all. We had a tentative graduated rate on net investment income on private foundations. So similar to the endowment tax on colleges that did make it in, there's going to be a graduated rate on the investment income for private foundations, depending on your net assets. That did not get anywhere. Same with employee parking. They were going to bring that into the definition of UBTI. Did not go anywhere. Name and logo income. They were going to try and call that UBTI. Did not go anywhere. So you can see a trend here, though, of some of the things they were thinking about that didn't happen. Who's to say in a different bill in the future these want to come back up? Because these were in the House bill that just failed to make it through the Senate. Then the last one is this broad power of the Secretary or the Treasurer to spend tax-exempt status for organizations supporting terrorist organizations. What we have seen as a trend over the last few years, there's been multiple bills that have been passed, or not passed, proposed out there trying to get more at nonprofits that deal with foreign organizations and foreign donors. There's been this very concern in Congress that this money is being funneled to bad actors. So that is a trend that has been out there. There's been talk about doing additional disclosures on the 990 if you have more foreign funding about what's going on there. Nothing came about with that, but that is a hot area that I've seen multiple bills proposed in over the last few years. And when I get to my industry trend slides as well, you'll see that as well, that we've had a couple more proposals about this area about Congress being very touchy and concerned about nonprofits who are getting any type of foreign funding. Even if it's for good purposes, it's just an area of concern. So with that, our tax updates for the One Big Beautiful Bill. As you see, not really a whole lot for nonprofits, but a few things that can impact your employees or your donors. I'm going to turn it over to Sam now, and she's going to get into some of our Form 999 overviews and best practices that we see.
Yep, like Dan said earlier, this is a little of the more basic information that's being presented, but it's still good and it's a good refresher for everyone. So 990 review public charities in general. It's the base of public support. The revenues are generally donations, membership dues, program service fees. Most of the time, we're not going to have 990s that pay tax unless there is that unrelated business income. And then there's no mathematical statutory requirements for expenditures like we see in private foundations. So for those private foundations, Most of the time, there's a limited pool of donors. It's often just coming, most of the donations are coming from one person or it's coming from a family group of people. Private foundations do get taxed on their investment income. There are those mathematical required annual distributions. And then excise taxes might apply if they are under distributed for a few years.
And if that stuff interests you, keep listening because further on in the presentation, I'm going to go into this in a little bit more detail.
A few common public charity types. I would say the majority of what we see are the 501c3. So organized exclusively for religious, charitable, scientific, literary, or educational purposes. There's also 501c4s for civic leagues and social welfare organizations, labor unions that are 501c5s, business leagues and professional organizations that are 501c6, and then social and recreational clubs that are 501c7. For the private foundations, they're both labeled 501c3s, but there's primary grant making organizations and then operating private foundations. So on the normal 990, not the private foundation, just a regular 990, there are supplemental schedules that get filed behind it. And some of these schedules can apply to private foundations as well. The first one is Schedule A. So Schedule A goes through the public support tests. There's two options for computing the organization's public support. You can switch between these two tests each year. The Part 2 test, which is page 2 of the Schedule A, is when an entity receives a substantial part of its support from the governmental entity or the public. Part 3, instead of receiving the majority of its support from donations from the public or the government grants, Part 3 focuses on entities that receive more than 33 1/3 of their support from contributions, membership fees, receipts from activities related to its exempt purpose. So this is mostly going to be your program service revenue. Also in Part 3, there's an investment income test, which is an additional support test where the entity cannot have more than 33 1/3% of its investment support coming from investment or unrelated business income. So then just going into those two tests a little more, the Part 2 test is organizations who receive their support primarily from contributions. There's a limitation on the contributions from each person that contributes more than 2% of the total income, but that's calculated over the 5-year period. That's not year by year. It takes in the current year and the previous 4 years. Government units and publicly supported organizations are not subject to this limitation. Their donations get backed out. For the Part 3 test, organizations that receive their support primarily from program services, so their limitation on the income comes from either non-disqualified persons, which there's a note about it, the disqualified person's support is limited to 0 because their donations don't get included. But then the non-disqualified persons are limited if their donations exceed the greater of 5,000 or 1% of the current year's income.
And if this sounds confusing to you, we probably get the most questions, wouldn't you agree, Sam, on this Schedule A and how do I meet my public support test at this 33 1/3%? I personally think this is a great slide to keep in mind for the two different tests. This is probably the highest level overview. That's also the most concise that you're going to see on what the difference between these two tests are and when the different limitations come into play. So if this is something you're thinking about or going between the two tests, or if you've had questions about how do these two different public support tests work, so I stay a publicly supported charity, this is a good slide to keep in mind about, okay, here are the very high level things I need to be thinking about. And here are where my contributions are going to be limited from donors.
And then also with Schedule A, there are supporting organizations. So this is basically a organization that's primary existence and purpose of being in existence is to support another organization. So these organizations do not complete Part 2 or Part 3 of Schedule A. They have to carry out the mission of their organization, and then they can either be type 1, type 2, or type 3 functionally or non-functionally integrated. And then on Schedule A, they're going to complete a Part 4 and 5. Okay, and then continuing with the schedules, the next big one that we see on almost every return is going to be Schedule B. So it's a listing of contributors that contributed either 5,000 or 2% of the income, dependent on Schedule A, which test they complete on Schedule A. One thing about Schedule B, though, is when it gets published on the IRS's website, the names and addresses of the donors are redacted. They don't get published anywhere. That is just for the IRS's information. And then non-501c3 organizations don't list the name and address. So then moving on to Schedule C, that's where we see political and lobbying activities. Schedule D has quite a few pages for different information that gets reported depending on, there's endowment funds, or if there are audited financial statements, that also gets shown on Schedule D. Just to run through them pretty quick, Schedule E is for schools, Schedule F foreign, Schedule G fundraising and gaming, Schedule H is for hospitals, Schedule I shows grants and other assistance to individuals and to businesses. Schedule J is compensation information. Schedule K shows tax-exempt bonds. Schedule L is transactions with related persons. Schedule M is non-cash contributions, typically over $25,000. Schedule N is for liquidation, termination, or dissolution. Schedule O is for all other supplemental information, and we do see that schedule most of the time. And then Schedule R is for related organizations.
And while this seems like an information dump out there, we like to throw this slide in here every year because some organizations, when they see this, it's like, oh, well, we have this. And we're wondering, well, should we be disclosing more on this? Or, oh, what does this really even mean to have a transaction with a related party? Or, oh, we actually do have non-cash contributions. We've just been telling people the gross amount of our donations. We didn't know we needed to break that out. So we like to throw it out here just in case something triggers somebody's memory and be like, oh, well, we do some big fundraising events. What does that mean for us?
So for public disclosure agreements, for public charities, the IRS publishes the 990 information to sites like GuideStar and Charity Navigator. And pretty recently, I believe GuideStar has transitioned into being Candid. I think it's called Candid now. Like I said earlier, the donor information is redacted. The only thing that shows is the amount. The name and address does not show up. Per IRC 6104, organizations must make their Form 1023 or 1024 and their Forms 990 available for public inspection. Best practice would require organizations to make their governing documents, conflict of interest policy, and financial statements available to the public. Private foundation, just a very high level overview. So for private foundations, there's computation on net investment income. There's book value versus fair market value of the assets. Donated stock, distributable amount computation, that's telling the organization how much they're required to distribute every year. They do disclose the names and addresses of donors that they donate to. And then undistributed income excess distributions roll forward. If there is undistributed income, that means they didn't make their required payments. And if you get a couple years down of being under distributed, then the excise tax comes into play. And then also private foundations are required to use EFTPS. a couple best practices for nonprofits. So the first thing is governance and review. The board should be reviewing the 990 before filing. This is not mandatory, but it is widely adopted that everyone on the board of directors receives a copy of the draft of the 990, reviews it, and then gives any comments back. It's also important for the board to implement and regularly review policies. So some of these policies would be conflict of interest, executive compensation, whistleblower, maintain minutes, financial and reporting accuracy. I mean, that one's kind of self-explanatory. Just make sure that just make sure all the information matches everywhere. Either it's internal or reported on your 990 or given out to your donors. Substantiation requirements. There's a couple requirements that you have to know about and at least do when you are receiving donations. So there's written acknowledgement of contributions of $250 or more. There's a couple items listed there. They just need to be given on it's a typical donation receipt that you would receive from a charity.
And we thought this would be a good refresher because with the one big beautiful bill changes for next year for 2026, the $1,000 and $2,000 that pretty much anyone can take advantage of, getting those receipts over to the donors is probably more important because they're going to need that to support the deduction on their tax return if they were ever get looked at. They would need some type of support where they have the receipt saying, well, yes, here's my receipt back from the charity with all this information on it.
For non-cash gifts, there's a little bit more reporting that needs to be done. You have to include a description of the property. And then if you sell the property or dispose of the property that was given to you, you have to file an 8282 unless the property is valued at less than $500. You do have to file that within 125 days of the sale, and you have to give it to the donor because that impacts their tax return as well. And then if the value of the donated property is above $5,000, you have to get a qualified appraisal for the property contributed to you.
But just to be clear, that doesn't apply to the organization, that applies to the donor. So if the donor is giving you some non-cash property over $5,000 that's not stock, that's when they need to go get that appraisal. You don't have to worry about it as a charity, you already have the property. But that donor should be aware that it's going to cost them a little bit extra because they need to find a qualified appraisal to do the appraisal, to put it with their tax return to get that deduction. So typically, I'm not a big fan of giving non-cash property to charities, and if it's not stock, because there's a whole lot more on the donor side that you need to worry about. It's much easier to get that cash gift, and I'm sure most charities would prefer cash than to get some type of car or what have you.
And then there's a quid pro quo contributions. There's a disclosure statement that is mandatory. So if you do have to inform the donor of the amount that is tax deductible, and then that basically just says they purchased something that there was a fair market value of goods or services provided by you. So not their entire donation to you is deductible on their tax return. There's a penalty of $10 per contribution and then up to $5,000 per event or mailing for quid pro quo donations over $75. Okay, and then just as Dan also said earlier, since we just got through our November 17th extended deadline, we did just want to bring up a couple high-level errors that we do see on 990s. So the first one is probably the most obvious. It's just the failure to file on time. This also can include not getting your extension timely. The return is due the 15th day of the 5th month after the tax year end. So if you're a 12/31 year end, then your tax return is due May 15th and your extended deadline is November 15th.
Sorry to butt in, Sam, but people might be seeing this saying like failure to file, that's obviously, I don't want to be late with my 990. But the reason is number one in our slide of common errors is We see it more often than not, especially if there's a new client coming in. They just never filed, or there's a change in the board and nothing ever happened. The reason I want to call this one out in particular is that penalty is very hard to get out of if you actually are late. We have tried. It is very tough to get out of it. And if you look at that $20 a day, like that adds up pretty quick if you missed it like a year ago and now you're trying to catch yourself back up. This is unlike a business return where for a business return, we can just write a reasonable cause letter and it would just go away. It is very tough if you're a nonprofit, if you don't fail on time or you file late to get out of that penalty. So that's why Sam has it up front, because it comes up more often than we like. And it is tough to get out of that penalty. And that's not a fun conversation we like to have. It was then when coming in and said, oh, we were late. What happens now? We kind of wince a little bit being like, this is going to be there could be a pretty big penalty for this. So don't file late is the moral of the story. Make sure there's someone at the organization that's keeping track of the deadline so it does not happen.
Yeah. Another common error is just board member reporting. So when the draft of the 990 goes to the board for review, make sure that you're looking at those board members. And then part 3, program service descriptions. If there's any numerical data, so number of volunteer hours during the year or number of countries operated in, if there's any numerical data, just make sure that that's being updated every year in order to keep those descriptions up to date. Make sure to maintain the up-to-date contact information. So whether that's the website, the address, or the telephone number. We know that there's turnover in organizations, so just make sure that that's getting updated too. And then Schedule A accuracy for those excess contributor calculations, and then disqualified persons reporting if applicable.
All right, so our requested topic from the prior presentation, uses of private foundations. When does it make sense to use a private foundation? When since someone set up a private foundation? And I'm just going to skip to the end right now and say, for most individuals, it doesn't make sense to have a private foundation. In our current climate, it doesn't make sense to set one of these up. Typically, you fall into it by accident and you're just stuck with it because you don't meet your public support threshold. That's typically where we see it, where the organization can't meet the public support test. That Schedule A test Sam was mentioning, where we have the 2 1/3 tests that are out there for the different options. If I can't make it, then I'm a private foundation. The important thing to know is this is still a tax-exempt organization. You're still not subject to tax on it. However, that's a little bit of a misnomer because there is an excise tax on your investment income. So now, if I'm a private foundation, I am paying taxes each year. There's also this mechanical 5% distribution of my fair market value of assets test. If I'm doing anything with related parties, it gets pretty harsh for what I can do. You have a little bit more flexibility with public charities. And unlike the public charity, my donor names and my recipients are much more public information. So people will know what's going on within your organization. Now, while I said there's not a whole lot of uses for private foundations, if you keep listening, there's a better alternative that's out there to accomplish some of these goals if I can't meet that public support test. I just wanted to give a quick rundown about, okay, what is a private foundation at a high level so people are aware of what this organization is. Because now I'm not filing the Form 990, I'm now filing the Form 990-PF. The big difference between the public charity and the private foundation, in my opinion, is this whole distribution requirement. Because now if I'm a private foundation, I am absolutely required to distribute out 5%, which is based on a monthly average of my assets during the year. And that monthly average of assets during the year adds another administrative burden and complexity where you need to keep track of all your assets and their average month by month by month. So it's an additional step Sam and I have to do when working on these returns to get the averages of all the assets during the year and then do this averaging calculation the way the IRS likes it. The other thing I want to mention too is you got to be careful with your grant recipients. As you see there, I have 4 different cautions to these different people receiving the grants. It might be possible to do in some of these situations, but there are some very niche rules you got to be aware of. Typically, if I'm a private foundation, I'm really just doing grants to other publicly supported charities. So I need to make sure that they have that Schedule A, they're passing the support test for it to count as one of my grants for this 5% distribution test. If I'm trying to give scholarships to individuals directly, I need to get IRS approval. I can't just start doing that. Public charity, I can do that. Private foundation, I have to apply to the IRS under a specialized procedure to say, well, I want to give scholarships to individuals. And there's a whole procedure I need to follow. Makes it more complicated if I'm trying to get money over to individual hands. For the distributions, though, I basically get to do it a year in arrears. So right now, Sam and I, when we were doing these returns, we calculated the 2024 distribution amount, but it doesn't need to be paid out until the end of the following year. So until the end of 2025. So while you do the calculations and figure it out, you basically get a year for you to make those distributions. So you can do it basically a year behind, so you know exactly what amount needs to go out. And there are excise taxes if distributions are not timely made. And unfortunately, we have seen this excise tax come up a handful of different times where distributions were not enough to cover, even when it was a year in arrears, for whatever reason, cash flow measures couldn't get that cash out there. And now we're subject to an excise tax and we have to file a separate return paying this excise tax for undistributing. But I still need to actually make those distributions in the future. The excise tax doesn't get me out of those distributions. So I have to pay a tax on top of making the distributions I didn't make. And sometimes you can get into some type of death spiral here where there's just not enough to pay for things without really selling off a bunch of the foundation's assets. So when should I actually use a private foundation? In my opinion, that's when I just have a limited group of donors where I can't meet that public support test. Even if I think it's questionable to meet the public support test, I typically recommend let's go for the public charity first. I get a 5-year grace period to see if it works out. And if it doesn't work out, maybe we just liquidate to some other organization that is a public charity as opposed to going the private foundation route. Really only makes sense if I know I'm only going to have a small number of donors, like a family or one individual. And just to reiterate the point, public charity status is normally preferred. If you look at what happens with my private foundations, well, with private foundations, I have like 10 different excise taxes I need to worry about that aren't the same for public charities. I have lower thresholds for my adjusted gross income for when I can actually take this charitable deduction. I now need to worry even more about disqualified persons. And disqualified persons, technical term, if I do any type of self-dealing with the organization, even if it's for like a good reason, I get subject to this excise tax. And I have lower disclosure thresholds for my grant recipients and my compensation I pay out to some of my employees and my contractors. So there's more information that gets tossed out there when I'm a private foundation that you don't necessarily have to disclose as a public charity. So the 3 main reasons where I see private foundations still win over the public charities is if my donor really wants that grant decision-making control. They want to have the final say where those monies go, no other choice. Or if I want official community recognition, since this is a separate entity out there, it's nice to have your name on your own foundation. You can put it out there. This is my family foundation. Or the last reason is if I'm trying to do legacy gifting over multiple generations, this makes sense. The one thing I want to caution on is if you're trying to do multi-generational gifting, you really do need to have some professional staff that you're paying out of this organization to manage the day-to-day activities because you're not quite sure how active the next generation is going to be. So what we've seen is the need to hire for paid staff to help run some of these private foundations, which adds more expense, adds more administrative complexity, just to make sure it's being handled. But if these 3 are very important to you, the private foundation makes the most sense. So, what's an alternative to this private foundation that I mentioned? What we are seeing is instead of the private foundation, people are going to donor advised funds. It's just a much better option overall to accomplish the same goals for the most part, except for one. But it can do basically anything that a private foundation can do, but almost better in my opinion, hence the question. So the donor advised fund is not an independent legal entity, does not file its own tax return. What you basically do is you piggyback off of another public charity, typically a community foundation, and you set up a sub-fund under that community foundation. And then on the sub-fund, you start paying the distributions. There's no annual distribution requirement, no 5%. But if you look at some of the statistics, DAFs typically pay out 8 to 9% a year. Grants are quasi-unanimous because sometimes when the recipient gets the grant, it's coming from that public charity or community foundation. They don't really know what's coming from that donor advised fund. So it's a way to obfuscate some of your different grants. The only downside, in my opinion, is you don't have real legal control of the assets once you give it to that donor advised fund. But I say that a little tongue in cheek and with quotation marks because really a lot of these community foundations will give the donor advisory privileges about where that money is supposed to go. But technically, that community foundation or whoever is holding that donor advised funds gets to make the final say for where those assets go. But I mean, at least in my opinion, every time I've seen one of these, they follow the donor's advice 100% of the time about where that money goes. So it's really kind of a better option than the private foundation if that's something you're thinking about. And I want to mention as well, what we are seeing as another trend is those that do have a pre-existing private foundation. I'm seeing more and more of these private foundations liquidate into a donor advised fund. So they're just getting out of the private foundation structure, too much administrative complexity, too much cost, too many calculations they want to worry about. They're liquidating the foundation into a donor advised fund and then running as a donor advised fund going forward. Naturally, when things sound too good to be true, they might be. So I do want to mention this out there that a couple of years ago I mentioned this. We have some donor advised fund proposed regulations. The whole goal of these proposed regulations were to make donor advised funds worse than private foundations with some of the things they were throwing out there. However, these are just proposed regulations. They never got passed, and they were under the Biden administration. When the Trump administration took over, these things are pretty much dead in the water. So nothing more has really come with these donor advised fund regulations. I mean, if you were to ask me personally, they really are too good to be true because you get around all the private foundation rules if you put in a donor advised fund instead. Technically, it makes sense to me that we would have some more of these restrictions out there, but it hasn't happened yet. So I do want to mention that if you're thinking about going the donor advised fund route, things could change in the future if these proposed regulations get passed, where now it actually makes more sense to be the private foundation if I want some of those benefits and I have a small donor pool or just one donor. So just keep that in mind, proposed out there, but there could be problems in the future. All right, we're going to take a quick break for those of you that need CPE. We're going to send out a polling question and mute here for maybe like 1 minute while people answer that. We'll look over some of the questions we've got in the meantime, and then we'll continue on with our last section for industry annual trends, which I think is one of the more exciting parts about just what we're seeing out there in the industry. All right, polling question is now closed, I believe. So hopefully those of you that need your CPE, you answered that very difficult question to get your credit hours going forward. And we will continue on to our industry annual trends. If you want to take us away, Sam, with our first part.
Yep, so just a quick snapshot of 2024. The total tax exempt entities in the IRS list actually decreased slightly from last year. Only about 400,000 of those file a full 990. There's around 135,000 applications for new tax exempt entities every year. And then the examinations decreased around 500 for this fiscal year. And then 2,000 IRS employees in the tax exempt group, which is an increase of about 600 from the prior year. I guess 800 new hires and 200 old employees that are no longer there.
And for those of you that are curious, most of the employees in the tax exempt group just work on determination letters. So of that 136,000 new applications, most IRS employees in the tax exempt group, that's what they work on. They read through those determination letters and approve or disapprove of those applications. So a lot of the new hires aren't really going to compliance. They're just really going to, well, we need to read through all these applications we keep getting.
And then Giving USA report for 2024, it was released this year in June. Total charitable giving increased 3.3% when adjusted for inflation. It almost got up to 600 billion. And then I will note that giving to foundations remained flat, and then giving to religion decreased slightly. All the other categories increased. And also in that report, 66.2% of donations were by individuals. That has been declining for a few years. And then most of the donations these days are coming from corporations and foundations. There's a couple emerging trends for nonprofits. The slides will be sent out so you can read through these later.
Yeah, it's more just internal governance and things you might want to think about. And then we also threw a slide in there just really quickly. We know it was a trend earlier this year with some of the changes with the administration. Government funding loss. If I lose some of my government grants, what are some ideas where I can try and get out there and get replacement for those funds? So Sam put together a couple ideas about, okay, if I lost government funding, here are some things I can think about. I might think about hiring a couple more people to help me out in this space if we were relying on government money and now we need to start getting more public funding. I'm going to go through a hodgepodge of just different things that are out there that I think it's good for people in the nonprofit space to know. So very, very recently, if you haven't heard, GoFundMe basically started creating pages for every single nonprofit that's out there, or at least all the big ones. And they did it without nonprofits' consent. So you might want to check to see if GoFundMe created a page on your organization's behalf. And I mentioned this too because there's concerns that, well, GoFundMe is using some of our stuff without our permission, and we don't want to suffer reputational harm for whatever reason, for whatever they have up on our website. And GoFundMe was taking basically an optional tip fee when donations were going through some of these pages. So they have stopped that recently because they got a huge backlash. But GoFundMe, for creating these pages, got a little bit of a kickback for some of the donations, which was also a concern to nonprofits because I would think if I'm a nonprofit, I want the full amount of money coming my way, as opposed to it being funneled through some organization I don't even know exists. So, big backlash, but GoFundMe has says they're going to keep all the pages that are up. So if they create a page, it's up there. You need to take an affirmative step to go on there and deactivate the site if you want it removed. Otherwise, it's going to stay up there. So we put a link in the slides. If you want to click on that, it gives you a step-by-step guide about how you want to go deactivate your page on GoFundMe. Or if you want to keep it up and claim the page, it gives you that option too. So now you have more ownership of it and you can actually see it. Like I said, and let me reiterate that, they did stop this tip option because the backlash was so huge. So now GoFundMe isn't getting anything from use of the donations through there, but it's still a little questionable to have that be set up without organizations even knowing that it happened. I mentioned this one last year, but I want to throw it up there again because this is definitely a trend we've been seeing more and more of. So if I'm trying to solicit donations from a state, various states are coming out there with their own requirements if you're going after donors within their state borders. A couple of years ago, it was California, very broad law that if you're trying to go and get money from California residents, you have state registration requirements. Hawaii very recently came out with something very similar. And if you look at the definition of what a fundraising platform is, it is very broad. So basically what some people have been saying is if you have a box on your website that takes online donations from people, that would be enough to fall under this Hawaii law where now you would have to do some type of registration with Hawaii just for having a donate now box on my website where I can take online donations. And if I'm getting money from people who are Hawaiian residents, well, technically I have to do all this reporting to the Hawaii Attorney General about what's been going on. Alternatively, if I'm using some other platform that's not a donate now box or I'm using a third-party service, I need to give third-party consent for them to go after Hawaii residents. So you keep that in mind if you saw something of that nature. That's why they've been sending that out there. We have seen from the trend that the National Association of Attorney Generals is going through public 990 data to see if state registration is required. Now, it's a little hard for us to see in Nebraska because when it comes to Nebraska state requirements, we're probably one of the most lax in the country for what we have to do for our state level disclosures and our involvement by our state level attorney general. Other states, much more intense. Like, I think the Ohio Attorney General is very hardcore about looking at their state level nonprofits compared to what we have here in Nebraska. So this is something that might trip you up, because if you're just operating in Nebraska, you might think, well, we have no state requirements. There's nothing for us to worry about. That's not true if you're going into some different state that's out there, particularly California and now Hawaii. You may have some state registration requirements, and you might get a state notice saying, well, what are you guys doing? You're coming after our state residents. Hopefully your eyes won't glaze over too much on this one, but this is another big emerging trend: foreign funding of nonprofits. I have seen this over the last 3 years, multiple different bills that are going out there. For whatever reason, Congress really does not like, and this is under both administrations, Biden and Trump, Congress really does not like foreign money coming into nonprofits. There's been a bunch of bills that have been out there that is just calling it very questionable. And very recently, there was a presidential memo out there trying to use this Foreign Agents Registration Act, saying, well, we're concerned that if you're taking money from outside the US, that you're really channeling that money to do political activities. And this memo says to use this Foreign Agent Registration Act, which came about from World War II and it hasn't really been used since then, to go after charities where they think you might be doing something bad with foreign money. So it's really trying to reach nonprofits to see what you're doing with your foreign funds. And I think it was last year even, there were some proposed changes to the 990 where we would have more disclosures about, well, if I get foreign funding, I need more recipients about where that money is coming from, where it's going from, because we're worried using these foreign dollars to support terrorist activities. It seems a little ridiculous to me, but that is something that they're very concerned about, is if you're taking dollars from outside of the US, that's not for some nefarious purpose. And off of that, there's this whole Front Act, which really expands this even further. So if you're doing anything with China, North Korea, Russia, and Iran, Cuba, and Venezuela, that could be a potential problem for you, where now you would have to register automatically under this Foreign Agents Registration Act. And it would be an area of concern. And there's some disclosures that are out there that might not even protect you, that you could historically rely on. All that being said, no, that's a little technical. Just beware of foreign money coming into your nonprofit. If that's something that happens for you, there probably will be more legislation that actually gets passed in the next couple of years about this, where we will have more serious disclosures to worry about. Lastly, I can speed through some of these, but I just had a few court cases out there that I thought were interesting. It's kind of hard to find good nonprofit court cases that are out there, but I have 3 out here of some things that we have seen. This first one had to deal with the Catholic Charities Bureau versus Wisconsin. It was an argument about religious charity not being able to get an unemployment tax exemption because Wisconsin argued basically, well, what you're doing is secular activities. There's no religious nature to your activities. You're serving the entire community. You're not just serving members of your faith. The services you're providing have nothing to do with religion. You're doing job training. We're saying you're not exempt for the unemployment tax. Supreme Court came back 9-0 to say, no, they really are a religious organization, even if they're not doing expressly religious activities. You really need to take a more closer look at this. Why it's important: federal government has a very similar statute. 40 other states have a very similar statute. More protections for religious activity if you're a religious organization. Freedom path. So if I'm a 501c3 organization, I cannot do any type of lobbying. I can't do any type of political campaign activity. There's a difference between that and lobbying. Or I can't go out there and support candidates. So what some organizations do is they set up a 501c4. So 501c4s can do some political campaign activity, but the IRS has never really gave us a standard for what that looks like. And that's what this case is getting at, very recent case too, saying 501c4s, political campaign activity, how much is too much? And at the end of the day, the court ruled that, well, parties tell me what you think should be a clear standard for when you have too much political activity. So I would keep an eye on this case if you are an organization that wants to support any type of candidates in an election. I know we just had the 2024 election, but coming up for 26 or 28, if that's something that interests you and you're a 501c3, can't directly support candidates, usually we see some type of 501c4 get set up instead. We're probably going to get some hard and fast limits on how much is too much. Because I can't have the 501c4 just do this political campaign activity. It has to do something else. But how much is too much? Because even in the court, they mentioned, well, is it 49%? 50%, 51%. We don't know, but hopefully we'll get some more guidance soon. Then the last one I wanted to mention is just one for my own amusement, really. It's just a case of a charity being a bad charity. They went for nonprofit status, but really the founder of the charity did everything in the charity for his own benefit. He complained when the IRS took away his tax-exempt status, but the case goes through and says, you failed pretty much every aspect of this operational task. You were just taking donor money and funneling it to yourself privately. There was huge private inurement here. You said you were out there trying to educate children, but you were really just trying to sell children all these different products, funnel the money to you, funnel it to some of your profit sharing plans. It was all coming back to you. You were just a bad charity to begin with. So these are the type of cases, though, that you see the IRS going after, where it's founders of charities doing bad things and privately benefiting themselves. So we'll take a quick minute or two for questions. We didn't see all that many come through, but we'll answer them as they came up. So if you want to take the first one, Sam.
Okay, does a nonprofit 501c3 with income of less than 50,000 only file a 990N electronically? The answer is yes. And that 50,000 is average gross receipts over the most recent 3 tax years.
So yes, you have to do the 990N electronically. You can't paper file that one. Thankfully, it's really easy. The IRS has a website where you can do it, and it probably takes anywhere from 2 to 5 minutes to get it done. So next question coming up, do you have to be registered with the state of Nebraska to take online donations? So here's why I wanted to call out the whole Hawaii situation. So Nebraska does not have this registration requirement to take online donations. So that's where it's a little bit different when it can throw people off, because other states are coming out with some of these requirements, but Nebraska does not have it. Moving on, can in-kind donations and value of volunteer hours be used for public support tests? Unfortunately, no. Unless by in-kind donations, you mean actual property donations. Property donations can count, but if you're just talking about service hours or services provided by people free of charge or my volunteer hours, unfortunately, they do not count for that public support test. So while we tend to disclose that in the narratives in our returns, because it sounds good to donors out there and they like to read that sort of stuff, unfortunately, you don't really get any type of credit for it when it comes to the actual tests. And then I have a last question about describing disqualified persons. That gets complicated when we're talking about the public charity status compared to the private foundation definition of disqualified person versus when they come into play. I might just follow up with this person offline to getting into the specifics, especially because we're already a few minutes over time. But with that, I'm not seeing anything more in chat. It was wonderful to have everyone with us here today. And enjoy the rest of your afternoon. Any questions, let us know. Slides will be coming. Thank you very much.
Thanks, guys.